Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive in there. We're going to take a look. I'll make some opinions as we go, and let's dive in there. If you want to follow me, it's at Finance. If you want to join our community, finding-value.com is where I dive deeper into these topics and look for individual investments that are out there to make their way into my portfolio. And you can see what I'm doing, when I'm doing it, and all of that stuff. So coming on down, we got Uselink XOP, which is the Oil and Gas Explorers ETF. He says a massive statement for oil gas explorers breaking out of that downtrend line here today. Big statement. Are we going to get a big move in oil here? And we're seeing positioning in XOP, OIH, a lot of these ETFs, XLE, and they're looking good. They're looking good. So hopefully we can get a move higher here in oil and gas. Rock bottom entry says gold miners breakaway gap above the 14-year downtrend. Sit tight, guys. This is a fun part of the move coming up. The one thing I will say is gold it's experiencing those tailwinds with the uninversion of the yield curve, the 2 and 10, 2 and 30, whatever people use, doesn't really matter. That uninversion is that tailwind. So people look for safe haven asset, and that safe haven asset is gold. And the gold and silver mining companies are looking really good, breaking through some of these downtrends here. So the name of the game here is to identify where the tailwinds are, to make sure that the tailwinds are behind your investments, make those investments, and then sit and do nothing. Sit and do nothing. So HFI research says an unsustainable oil price spike is coming. It says if crude exports remain low in August, then the probability of an oil price spike by October is close to 90%. I dabbled a little bit in the article of why that might be the case, and we're seeing volumes drop out of OPEC dramatically. And maybe they don't want a guy named Biden in president, so maybe they're helping get him out of office because he is so special. He's so special. That's what I'll say. Tavi says gold is on the verge of making new highs again, yet retailers remain on the sidelines. For me, this indicates just how early we are in the cycle for gold and other precious metals. Take note of the steady relative performance of miners in the recent weeks. He says we are likely experiencing a meaningful shift in this industry. We've got gold prices, and then the lag behind it is the GLD ETF. It's minus 23% from peak levels there. Maybe he thinks that will catch up. XLE, which is another energy select sector ETF, breaking out of its downtrend. And there's a downtrend line here, and it's breaking on out. It looks pretty strong and solid there. So oil and gas is looking a lot better. I'm feeling a lot better about the oil and gas sector now that we're getting these breakouts. It should be very confidence inspiring to those that are invested in the oil and gas equities, at least in the short term. Energy headline news: average long-term inflation expectations have begun to shoot up only in the last few months. If they're even close to correct, then the Fed is on course for abject failure. Bloomberg opinion. And look what we've got here. It says something bizarre is happening to the long-term inflation forecasts. As inflation falls, consumers' longer-term expectations go through the roof. So the expected inflation rate in 1 year is still pretty low, but when we look at the expected inflation for the next 5 years, mean percent, they have this going up over 6% for the CPI. What's up with that? Is that what we're going to get? Is this just expectations? Why are the expectations so high? I don't have those answers. I expect long-term inflation to go way up. we have some serious issues in spending issues, fiscal spending issues. We're in the middle of a real estate expansion phase, and those have all been supportive of higher inflation. I posted this again, and I wanted to go over this real quick. During our question and answer session, I went over the real estate cycle and all these things, but I still want to go over one thing. Five is technology. And we had all this stimulus come into the system. And that stimulus may have shifted money in the markets a little bit differently for a short period of time. I think that we are still in the middle bull, like we're ending the middle bull, going into late bull. And in the beginning of a late bull, energy, basic industry, capital goods, and precious metals, we have to be somewhere in this middle bull somewhere. And I think we're going into the late bull, which 9, 11, and 6 do very well in. So we should be looking for those things. And we're looking specifically for outperformance. So what I did is I looked at technology stocks against, say, not really XOP, but I've got it right here. So I can go down to NASDAQ, and I'm looking for a rollover or sideways move in this composite index. And we can compare this chart with, say, something like an XOP. And what we're looking for is we're looking for a move lower. Lower, lower, lower. So since 2020, and I know you guys are all over the NASDAQ. The NASDAQ peaked in 2020 of October. That's when I invested all that money into oil and natural gas. This has been the outperformance. The oil and natural gas stocks have outperformed the NASDAQ. That is no questions asked. Now, recently, we've had a move higher. That's what this move is. But more or less, let me get some really good, better candlesticks here. But more or less, what this could be, just to kind of throw that down there, this could be one big flag pattern. So we came on down, we had a little consolidation there, came on down, it's coming up, and what I think is going to potentially occur is another break lower. I think we're going to go way down here to some extent during this. The cycle, when you look back and you look at the cycles, and again, that's what my opinion is, and I'll keep going with logarithmic here. Your basing pattern, last bull market for commodities was back in this section here. And then NASDAQ went sideways like that the whole way. It was chopping back and forth. This here is a shoulder, head, shoulder, and a breakdown of that shoulder, head, shoulder. That's an end of trend movement. And everyone is still hung up on the NASDAQ. I think that this here is more or less, if I were to kind of just draw it kind of quickly in here, that's a rising wedge that we are getting, and that we are going to fall back to some level where XOP basically outperforms the NASDAQ. And this here started in 2020. So if you look at it from a relative outperformance and you go back to here, I think we're in the middle bull to late bull, and we're transitioning into that. That's why we're seeing the energy stocks outperform. Now, the energy stocks may have outperformed here more dramatically because of the stimulus money that came into the system. So it's coming off of a bottom. This is your bottom here. And then we have a long way to go lower for this ratio where energy could outperform. And you can also look at this, say, versus, and you're going to start to see precious metals start to outperform as well. So we can put something like SILJ there, and you're going to start to see a peak, in my opinion. So there's your throw over top, and then you've got this squeeze upward. And this is also indicating where we're at in the cycle. Your throw over top, this is going to come down, and my guess is this is going to come and break lower. SILJ and GDX and all those will start to outperform, and we can also use the big boys, which has a very similar chart, and it's all squeezing on up in rising wedges. This will fall and break lower. That's also indicating that 11 precious metals are going to start to outperform the technology stocks versus 5. So that is an indication of where we're at and coming up out of the middle bull into the late bull when these things finally break to the downside for energy and precious metals. So that's why I reposted this. Again, I wanted to make that comment about the potential breaks here and using ratios to determine where we're at in the cycle. We've got coal here as well. This is another energy. And he says thermal high-grade coal price, dollars per ton, is definitely bottoming and it's ready to turn on up. You can kind of see this rounding bottom that's occurring here. Yeah, definitely. We had that rounding bottom here too as it came on around. Trump and the bear steepener, exiting inversion, big developments. So since the presidential debate, the U.S. 30-year treasuries and 10 bips wider and higher in yield. That's with softer economic data driving twos 30 basis points lower in yield. Pricing in rate cuts, bull steepening here is what he has for that. There we are, looking like we could uninvert here. Let's go back. We've got when to buy stock XYZ, and he's got stage analysis here. This is stage 3, stage 4 breakdown, stage 1 base, stage 2 up. Your ideal buy point for most of these is the pullback here when you look at technical analysis. Now, if you can dive deeper and deeper into the cycles, and what you can do is you can front run this because if you understand what is driving the herd to create the patterns, you then can look at the root cause of why the herd is making these patterns. So you can front run and start to buy the bottom down here because you know what is driving the herd to buy it and push it to the uptrend. You can also use sectors or leading stocks in the sector that have broken out of stage 1 into stage 2 here, and then buy some of the smaller companies that are still down in stage 1 for maximum ultimate return. But what they say is basically when to buy is the stock initially moves out of stage 1 base and enters stage 2. Risk is extremely low. Support is just beneath the purchase price and an excellent upside potential. The entire stage 2 advance lies ahead, but need patience. It can take time for solid stage 2 momentum to build. After stage 2 is well underway, when stock drops back close to its moving average and consolidates, the moving average should still be clearly trending higher. Then it breaks out anew on top of resistance zone. This is continuation buy. Early bull market, plenty of stocks breaking out for the first time. Later, very few, but still plenty of continuation variety buys. The rule of thumb is 80% continuation buys, 20% early stage 2 variety. Use buy stops within set limits. I don't use that stuff there. I've taken a completely different approach than the normal technical analysis. I'm a complete hybrid. I'm of the opinion that technical analysis is just an extension of the psychology of the herd. And the herd moves because of reasons. They buy stocks and they alter their investments to other investments because of the things that they are subjected to in the market. So I think there's ways that you can front run even a stage 2 breakout with some sort of high probability of success. So I'll just say that. This is non-biased, honest evaluation. Are these charts bullish or bearish? I got an overwhelmingly bullish format on all of them, and they are home builders. They are home builders. The real estate market is in for sharp correction with losses that could take a decade to recover from, per Chris Vermillion. Now, my question to Chris would then be, well, why are all the home builders have bullish charts when all of the people that looked at this said it was bullish? Why would you come in and say that it's bearish? That is what you don't want to do. If you play this game, you want to be in the game where if you see positive developments in your charts, that is an indication that big money, is flowing into the home builders. So if there's going to be a sharp correction with losses, why are people piling into home builders? I'm pretty sure if interest rates go down, home prices are going to go up because home builders are going up. The smart money is accumulating home builders, they're not selling them. Last time in 2005, which is right here in this peak, the home builders rolled over in 05, created a shoulder, and then went down. This is exactly what's occurring with some of the ratios I just showed you of technology stocks versus energy stocks. The key here in all of this, this is the key. You have to get your information not from experts, but directly from the market. Then you need to decipher what that information is telling you. Because the experts, in my opinion, are not experts. They don't know that you have to basically gather all this information and then draw a conclusion from the information in an unbiased way or approach. So then my question is, how are we going into a real estate crash and all of the smart money is piled into the wrong assets? Because a crash is not going to occur. They're going to lower interest rates, home prices are going to go up, and they're going to sell more homes, more new homes. And that's why home builders are going up, not down in the medium term, as well, I'll call it. Strong move today in energy equities. Once the storm-related data flattens out, you will see the impact from deeper OPEC export cuts in June. Demand is solid. USO roll done today, and fundamentals are poised to buttress higher oil prices in the coming weeks. And here's XLE. He says there it is. Breakout for XLE, supporting his opinions up here. The money is rotating into it. Here's a quote from Howard Marks. He says, "Not only should the lonely and uncomfortable position be tolerated, it should be celebrated. Usually being part of the herd should be a reason for worry." It says, "Buying a stock at the right time minimizes risk and maximizes profit." And I do talk about that. Your entry points is what reduces risk. So if you want to take a highly volatile company, you should be buying it at the right time. Be buying it at the right time. And that's where these technical analysis charts come into play. You should be buying it in stage 1 down here or stage 2 on the breakout, depending on how you're looking at it. And also depends on if it's a leader or a laggard, because you can buy a laggard in stage 1 when all the leaders have broken out into stage 2. And that's your risk, is that it doesn't break into stage 2. Inflation and interest rates may stay higher for longer, warns JP Morgan CEO Jamie Dimon. So he's in the higher for longer camp, apparently. Here's one from Seth. He says, over the long run, major mispricings are eventually corrected. The share price and value of a business tend to converge because short-term illusions are pierced and enduring characteristics become more apparent, says Seth. And that's all I've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. And that's all I've got for today. So we'll catch you next time. This is Finding Value.